I noticed that, but I didn't say anything because I didn't think it was that big of a deal, but that's okay, as long as you know you did something wrong. Where are we? All right, so what's up in the market? Oh, I forgot about these. Remember last week we shorted oil? Not here, we shorted oil, God knows where it was when we shorted it. I guess it was $1,000 ago, so it was 63.75 is where we shorted oil. We were a little bit underwater early this morning, or an optimist would say we could have shorted it again. But so here we are at 62.50. I would put a stop at 75, which means we want to buy it back since it's a short, right? So you just put a stop in like that, and if it hits that number, then we'll get stopped out. If it goes lower, then we'll just keep making money. So we'll see how that goes. Why are you making noises? What? Hold down to issue a limit order. I don't know what that's doing. Oh, it's that box. Cannot confirm send order while reconnecting. Why are you reconnecting? So what does that mean? I have it in or I don't have it in? Nope, for whatever reason, it's not very happy about this. Oh, I see. Yeah, it's logged out. There we go. Hello? Oh, there it goes. All right, anyway, we won't use that. We'll use the futures then, and we'll see how things are looking on the 1 hour chart. So as noted, notice that the futures are above where the actual trading is on oil. But, you know, everything's elevated. Nothing that's happening right now matters until we see what the Fed is actually doing. We'll take a look at the indexes. Wow, really coming down fast, aren't they? That's interesting. So if we look at like the 5-minute view, when did this all start collapsing? At noon, not so much. From the open, the Nasdaq's been selling off. So the Dow started collapsing at noon. The S&P has been selling off since the open. The Nasdaq's been selling off since the open. The Russell was going up and then suddenly at noon started collapsing. So we don't know what's happening exactly, but it must be interesting. Let's see what recent news looks like. StubHub, don't care. Evolution Petroleum, don't care. La da 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 da. General Mills, increased confidence in strategy, 25. Oh, that's good. Good for you, General Mills. I like General Mills, you guys know that. Deutsche Bank, JLL, Gensler says markets will be volatile if companies only report. Yeah, no shit. That's a terrible idea, by the way. Embraer, Strike, don't care. Uh-oh. Now I'm tired. Why am I tired? Microsoft Copilot. Oh, you know what can fix that? Matcha tea. All right, hang on. Like Popeye. Dun, 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 dun. All right. AI is now going to run Congress. That's good to know. That is seriously good to know. American Express downgraded at Freedom Broker, blah, 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 price to earnings multiple, blah, blah, blah. Blockchain guidance, somebody's trying to take control of this. Reddit and Google in talks in their next content agreement. They rely way too much on Reddit. Microsoft signs, not just them, but all of the AIs treat Reddit like it's much too official. And you know what they don't do? They don't treat Wikipedia like it's official, which cracks me up. I know the conservatives think that Wikipedia is somehow evil, but you know, it's actually really a phenomenal system that makes sure you get some very middle of the road information on everything. And but because of the backlash from conservatives, they don't like Wikipedia, but they do like Reddit for some reason. But very interesting stuff. Microsoft, $6.2 billion deal here. European indexes. By the way, Trump's running around Europe. See, the headlines are that obviously everybody's paying huge amounts of money in America to build AI warehouses and so on and so forth. But you know, you can't just build things in America. It's too laggy if you're doing things overseas. So you have to build hubs in Europe and hubs in Asia and so on and so forth. So of course, Microsoft needs data centers in Europe, and they're going to build them in Europe the same way they're building them in America. They just don't have to build them as big in Europe. And Trump is basically running around taking credit. Anything anybody is spending money on in Europe, Trump is taking credit for as if he made it happen. It's really hilarious. And the Europeans are just looking at him like, dude, it's like we do understand how business works. So very interesting stuff going on in Trump's world tour or European tour, whatever the hell this thing is. It's not even technically an official state visit. He just like felt like going to England. Anyway, waiting for the Fed. That's generally the gist of what we're doing today. Here's Kroger. I don't see anything that would have particularly knocked the market down. Scott Bessent's apparently also in trouble for mortgages now. Let he is without the first mortgage cast the first whatever the hell. You know what's weird though is when this accusation thing, like you accuse Lisa Cook of having a fraudulent mortgage, and Trump tries to fire her without having an inquiry. Just the second the accusation is out there, he wants her to step down and resign, which is what they did to Kugler, by the way. They got some dirt on Kugler, and Kugler resigned. That's why Trump just got to appoint what's his face. Because they shoved Kugler out. Whatever they had on Kugler was bad enough that she got out without even a mention. She just suddenly stepped down for personal reasons. But it's the same crap. They had something on her. They had something on Cook too. She refused to step down. They made a big public splash about it. Now it turns out that her application actually did say that it was a vacation home, and but the problem is there's no consequences. Nothing happens to people for making these accusations. You can sit there and make up shit and try to destroy a person's life, and they are destroying her life. They're telling her, you have to quit your job, you have to step down, we're going to publicly ridicule you, we're going to make your name synonymous with fraud, and yet none of it was true. And there is no backlash to it. And honestly, until people start turning around and suing Trump for $15 billion, the way he likes to sue people for $15 billion, it seems to be the magic number, 15 or 20. Whatever you do to Trump costs you $15 to $20 billion. So until people start turning around and suing him for the same amount of money, it's not going to work. But the problem with that is, ordinary people can't sue for $15 billion. It costs $1 million just to have the lawsuit and fight it out in court. That's $1 million right there. But what so what you need then is you need somebody like George Soros to back it and say, I'll back your lawsuit and just give me a cut if it comes in. But then, of course, they'll say it's all being engineered by George Soros. But who's going to do it other than a wealthy liberal who wants to make sure that Trump has the same accountability as anybody else? Because the way it works right now is they get to just say anything they want about anybody. Doesn't have to be true. And if it's not true, they don't even lose political capital. The supporters don't even care that it's not true. They move on to the next accusation. This is crazy. This is no way to run a government. This is no way to run a society. It's just insane what is going on in the world right now. But it works because people are intimidated. You can see it if you pay attention to the late night shows, that they are all reining it in. They are all pulling back, and they're all being very careful to say allegedly and supposedly and according to. I don't really know if this is true, but you know, all the language has to be pulled back to be careful about what you say about Trump and his buddies, because they will sue on anything, and it doesn't have, you know, if you're an ordinary journalist or a regular or a small publication or something like that, and even if you're the New York Times, you can't afford to get sued over things constantly. But a regular person getting sued for $1 billion because you said something that Trump took offense to, and he's got 45 lawyers on it. And you know, I don't know if you guys have ever been sued, but when you're sued, if you don't put up a defense, you lose. Lawsuits are all about the weight of evidence. And so when they, you know, they're going to come in with file cabinets full of evidence. And if your lawyer is like some country bumpkin and he files a brief of, you know, a 45-page brief saying this is outlandish and this is ridiculous, because the judge just looks at the file cabinets and he looks at the little report from your guy, and even if it's obviously true, they're still going to find in favor of the literally weight of the evidence is a literal term. How much, whoever has the most weight, evidence by weight, tends to have an advantage in a lawsuit. And this is, you know, I'm sorry, I don't want to go on about this stuff, but it's just so crazy what's going on now. It just really is. And it does matter. It matters because like this thing about cutting back the reporting times for public companies, you know, having only 2 reports a year instead of 4. It's less information. It's distortions and less information. We rely on this information to make our investing decisions. And nobody cares. Not nobody, but barely anybody. Oh, we're gonna give you half as much information as we used to about companies, and we're gonna give it to you much less often than we used to. So we're gonna literally give you half as much information about the running of companies and their finances and how they're performing. We're gonna literally cut that in half, from 4 reports to 2 reports. Physically half the information you used to get as an investor. And do the investors complain? No. They're like, oh, okay. and so they're doing that. So they're giving you half the information, and they're also going to take twice as long to give it to you. We're gonna cut your reporting period from 3 months to 6 months, so you'll get less information and you'll get it in twice the amount of time. So they've effectively knocked down your ability to get company information by 75%, not 50%, but really by 75% of your information gathering ability is being hampered by this move. And who is it not hampered for? It's not hampered for people who can afford to fly to the conferences that go on all the time all over the world, where they get presentations by these companies, or the people who have analysts who are speaking to the people at the company actively on a daily basis and watching all the news and checking all the stuff and getting information on a regular basis. Highly paid analysts who work at the desks at Morgan Stanley and JP Morgan and Goldman Sachs and so on and so forth. Those people are getting all the news. They're getting as much news as they always get. They always had an advantage over us. Their advantage is they get daily updates of everything that's going on in the company, while we get quarterly updates. But now they're getting daily updates because their access isn't being cut. They're getting daily updates while we get 6 monthly updates, biannual, semi-annual, biannual, semi-annual. I don't know, whatever it is, every 6 months. It's ridiculous. Now, I don't care, because my AIs get daily updates. Realistically, they're gathering information and getting it all. You know, when we haven't been surprised by an earnings report in ages. You know, it's like that doesn't happen anymore because we have such phenomenal information coming in. But now I have to be more proactive about it and make sure we're getting it, because you can't go by the semi-annual report. Now, I haven't done it yet. Nobody's approved it yet, but it shouldn't even be a thing. The reason half of the world's money is invested in US stocks, right? We have a $60 trillion market. You know, all the stocks in the US are a $60 trillion market. And the reason we have a $60 trillion market out of the entire planet's $100-and-something billion market is because we have the best reporting systems and the best financials and the highest degree of confidence and the best laws that protect the investing structures and so on and so forth. Without that, we're nothing. And America's dominance in the markets can slip away. It's not even something you think about because we've had it for so long, we take it for granted. But we take it for granted because of the laws that they're stripping down and tearing apart. I mean, people, we got to take this shit seriously at some point. Anyway. So Wells Fargo banker allowed to leave China. Oh, how nice. Gonna get our banker back. State Street launches cooperative ministry target, blah, blah, blah. Apple likely up as lead times rise. AstraZeneca fails to meet their goal in the lung cancer. Health insurers pledge continuing coverage of COVID shots. Wow, that's interesting. It doesn't mean all health insurers. It means Pfizer and United Health. Puma jumps on report of interest from authentic brands. Who are they going to buy? Puma? Netflix is still strong. Is a recession on the horizon or not? Maybe. CDC, blah, 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 blah. Okay, I don't see any particular reason why we are down. The market turned lower at about noon. Do you see a specific cause or just pre-Fed jitters? Did the dollar bump up? Oh, we didn't look at that, did we? It's possible the dollar bumped up. Oh, now they're turning back up. So much for that. Currencies. Maybe the dollar bounced. Nah, not really. And energy. No. All right, see what Bodie says. He's still thinking about it. And which Warren has the Fed report? That's the question. Cyclicals, QCOM, Avgo. La da da. La da da. And Fed statement analysis. Okay. Oh my God, what are you doing? That's very interesting. He's either having a hard time or he's stuck or he's overloaded somehow. Oh dear. What are we going to do? We're just going to wait for the Fed. Oh, so if we're waiting for the Fed, why don't we just have a fun time going over what we've been talking about lately? Ohm. Oh, I know. We can look at the portfolio reports. Yay. All right. So today I was talking about the Fed stuff. And should I say something about that? If I start talking about this, I'm going to get into a whole thing. All right. Just keep me on a leash. Dude, what's wrong with you? Last two reports, September 3rd beige book, Boston districts. What do you think? Core CPI. No. Here are the most recent two reports I looked at. The last Fed data I saw as of 9/17. Oh, last two reports, September, the beige book. That's not good. All right. I got to give them the updated information then. And what's wrong with you? Huh. Yeah, see, he was stuck. Now he's fine. Pre-Fed jitters, investor caution, Fed uncertainty, profit taking, seasonal weakness. Oh, yes, and there's nothing really going on. All right, good. Thank you. Man, that's how long it should have taken. This computer is like upset because I haven't restarted it. It's got a little problem. Your device needs to restart and install important updates. All right. Which way Wednesday? So what I talk about today, I talked about the decline of the dollar, which you know, I just cannot emphasize enough how critical this is. Nobody pays attention to it. It's down 12.36% since January, and the market is up about the same, and that's the whole market move. And that's including the Magnificent Seven drastically outperforming the rest of the market. So the broad-based market, if not for the decline in the dollar, would be down significantly, down almost 10% this year. It is actually an illusion. It's not like an illusion, like an expression. It's actually an illusion. The thing that we price stocks in, the dollar, has devalued by 12%. That causes everything that we look at that's priced in dollars to be 12% higher, including, by the way, your home, including automobiles, including everything. All right, so it also means that you're paying less than you think you are for all these things where they blame inflation. It's really not inflation, and that's the crazy thing. I mean, obviously, dollar weakness is a sign of inflation, but really the thing you got to focus on is the dollar itself. The dollar is falling apart. Therefore, you need more of them to buy things. You can call that inflation, but it really isn't inflation. It's a weak currency. There's a difference, okay? Inflation means the price of goods and services is rising, but that's not the case when the thing, the thing that you measure price in is changing. And nobody, I mean, how does nobody talk about this? How is it never on the financial news channels? How does no one ever ask the president this at a news conference? How is this not discussed? We used to discuss strong dollar policies and weak dollar policies. You know, back in the Reagan days and back in the Clinton days, that was a thing we talked about. It was an important part of American finance policy. Now we pretend that it doesn't matter that the dollar dropped 12.5% this year. How would that not matter? On what planet does that not matter? And it's not a tax on your current salary. It's a tax on every dollar you've ever saved in your entire life and your stuff. If you live in a $500,000 home, and last year you could have gotten $500,000 for it, and now you can still get $500,000 for it, you lost $50,000, $60,000, because the $500,000 you get has 12.5% less buying power. It's not even complicated. Oh my God, it's so stupid. It's literally like being in a science class and measuring the temperature of water or whatever, and so the student raises his hand. I'm the student. I raise my hand. I go, is that Fahrenheit or centigrade that we're measuring in? And the teacher goes, doesn't matter. It's like, how can it not matter? How can you possibly say it doesn't matter? It's not a thing. I don't know. I mean, honestly, it's like you guys, I mean, you know this. It's not me being delusional. I'm the only person who cares. And you might say, oh, Phil, that makes you crazy. And I'm saying I'm just as crazy as the guy who raises his hand and being the only one in class. And is that Fahrenheit or centigrade? And the teacher's answer is, doesn't matter. It does matter. It doesn't matter that nobody in the class cares. It doesn't matter that the teacher tells you it doesn't matter. It matters. It's a verifiable scientific fact that it matters. Anybody with an inkling of what temperature measurements mean would know that it matters. But that's the problem, is that, you know, and we talked about this too, like last week or the week before. It's this whole dumbing down of society thing. It's that the people who do the news, the people asking the questions, the reporters at the White House, they're more like influencers than reporters. You know, a reporter, in fact, I just did today, I said something about good night and good luck, like Edward R. Murrow used to say. Those guys were, they were intelligent people. They were trained news people who understood the subject matter they were talking about, because they didn't have a little thing in their ear telling them what to say, like every freaking news reporter does these days, that they just say whatever the freaking guy, that they say whatever their technician says. And you'd say, oh, well, that's fine though, because that means there's a whole group of people in the control room telling them what to say. So you can have like a talking head. You can, but the problem is the people who are talking heads, not all of them, I want to say, because I'm going on TV soon. Not you. But the people who are talking heads on TV, and they got the thing in there, if they don't want them to be confused. I've had this conversation with controlling controllers? I don't know what you call them. But you know, you get pre-interviewed. So I go on a show. I get pre-interviewed. I don't get pre-interviewed by the host or have any conversation at all with the host. I talk to the pre-interview guy or a couple of people in the pre-interview. They ask me the questions. They ask me to give them answers, and they hate it when I go off script, which I always do. And again, you know why they do that though? Because half the people they interview aren't smart enough to give the answers, because most of those people are cheating and using computers and so on and so forth. And yes, I use AI all the time. I'm not cheating though. I am as smart as the AI. I know what I'm talking about. I use it to make myself more efficient. I'm not using it to think for me. And that's a big difference. But now, how can you tell? You know, I've been doing this for 20 years. Everybody knows I know what I'm talking about. I'm not pretending. But there are many, many, many people now who are just freaking pretending, because now AI has made it possible for every single person to be a talking head. They don't need to know what they're talking about. My daughter noticed this. You know, in New York, she works in New York, and she says it's unbelievable how many people that clearly are using AI, and that when you know, when you actually have to talk to them, they don't even know what they said. They didn't actually say the things that they communicated, and they didn't write the contracts that they didn't read the contracts that they sent over, things like that. It's insane. And God forbid there's a power outage, everything grinds to a halt because nobody knows how to actually do anything anymore. And this is only a couple of years into AI. Just wait 10 more years until everybody's 100% dependent on this shit. And it's like, ugh. To some extent, it's natural. Natural is a weird word. I don't know what to say. It's like that we all used to know how to fix a car or had some vague idea of how to fix a car, in that we knew that there was a carburetor and there was a hose and there was a radiator and there were some belts and things. And you know, it's, if your car broke, you would open up the hood and look, and maybe not everybody, but a lot of people, I'd say most people who owned a car would look and say, oh, there it is, that's what's wrong. And based on that, they would know how bad it was and what to do. But then cars got more and more complicated. And now when you open the hood of your car, there's just a big block of metal with you can't tell what's going on in there. It's just a big metal block that they put in your car, and that's the engine section. And that you don't even have a tool that could open it or do anything with it. And if you did, you'd void your warranty. So therefore, you know, in absence of being a mechanic, your car is useless to you if it breaks down, because you can't possibly fix it. So that's kind of what we're heading towards. Now, you say that's fine because cars don't really break down. That's the other thing. Cars used to break down all the time. We've all had, in the past, flat tires. We've all had overheated radiators. We've all had problems with our carburetors and things have gone wrong. We've all had a belt break in the car. These things don't really happen anymore because they're better designed, and because of the closed systems and so on and so forth, it protects everything. You know, cars run for a very long time without having a problem. Even the tires are much better than tires used to be. So you're much less likely to get a flat. But we lose all the skills for doing these things. You know, we lose the ability to take care of it ourselves. So if it does break, it's a big lump of metal sitting on the side of the road, and we're like, I don't know, get me an Uber and get me out of here. There's nothing I can do for this thing. That's happening to everything. And we're hiring people not because they know what they're doing, but because they know how to fake what they're doing, or they know how to look like they know what they're doing. And God forbid they actually have to do what they say they can do, and they can't do it. You know, and then you say, well, and to some extent that's okay. It's like, it's fine. You know, it's more important to know how to work the AI than it is to know how to do the job, because the AI does the job better than you would do it if you did it yourself. It's a little crazy, but that's how it is. And you kind of have to admit that. But that's fine too, by the way, because I was thinking about this, because as I've mentioned, I'd say AI makes me about 10 times more efficient. I mean, literally, I can do things 10 times faster than I used to do. And that's fantastic, and that's great. And for a person like me, I'm already a peak operating person, so it just makes me much more. I could hire 20 people and they wouldn't be able to do 10 times more work than I do. But I can have one AI, or actually I have a bunch of AIs, but I can have my AIs and they can help me do 10 times more work, because they cut all my little bits and pieces down. Now, fine. Compare that to a crane, right? And you're at a construction site and you've got this great big crane that's the size of a house, and it can scoop up a ton of dirt at a time and take it from one place and move it by spinning and drop it off in a truck, and the truck takes it away, and boom. Now, that operation, if you were building a pyramid or Stonehenge or something, would have required 1,000 men and would have taken a week, even with 1,000 men. Meanwhile, I'm like, if you watch a construction site, there's like 20 trucks lined up, and the thing's just dropping tons and tons of dirt into the truck, and you're digging out a massive, massive hole in weeks. It would have taken years and thousands of men. So all those people who we used to call slaves, when they went and got jobs instead. They don't work in construction anymore. they don't get whipped every day to build pyramids and whatever. We instead have a few cranes that do all the work of thousands of people, have been replaced by a few cranes. Is that detrimental to human society? No. Was there a certain time at which the displaced workers had to leave and find jobs elsewhere? Yeah, that's the whole story of Moses, right? He took all the unemployed diggers out of Egypt and went to the promised land of Israel, where they built a new city. I might be mixing my timeline up slightly, but you know what I mean. But no, all these people who got displaced by machines got jobs. All the people who used to drive wagons or carriages, I guess would be the nice word, right? So everybody used to get around by horse. When you look at New York in the super old things, like there's some really, really old films of New York, and it's like half horses on the road and stuff like that. That's how we used to get around. There was a couple of 100-year period, or 500-year period, whatever it was, where we got around by horses in cities. No, there were no cars. There were 0 cars, and there were a million drivers, or whatever the proportional amount was. There were, so there were a million people employed in the horse driving industry, and there were no cars at all. Now there's a million cars, and there are 0 horse drivers. Where did they go? And you know what the reality is? They found other jobs. They found something else to do, and our economy went up. It didn't go down. It didn't collapse because we replaced all the horse drivers. It didn't collapse because we replaced all the slaves making pyramids. They found other work. These things are disruptive, but they are not necessarily destructive. That's a very important point to consider. Anyway, where are we? I'm watching the clock. All right. So this dollar devaluation thing, though, that's insidious because it's taking away all of our money. And like I said, it's not just a tax. It's not just a 12% tax on this year's wages. It's a 12% tax on everything you've lived and saved for your entire life. Remember when they floated the idea of a wealth tax that would take 5%, 10% of a person's wealth to balance the budget? That's kind of what this is, except we're not balancing the budget. We're just redistributing the money from the bottom to the top, because the people at the top are benefiting from the devalued dollar because our commodity assets, which includes cryptocurrencies, so cryptocurrencies are things that are priced in dollars, like cryptocurrencies and commodities and stocks that are all priced in dollars are going up. And I mentioned also new homes are going up in price because they cost more to make. Not a used home, a new home is going up because it costs more money to make because, again, of the raw materials and the lower dollar buying power. But the problem is nobody can afford it. New homes have gotten to the point where people can't physically afford to buy them. And therefore, they're not selling. Therefore, they're not being built, because if you can't sell them, why build them? But that's kind of an unbridgeable gap. I used to drive past neighborhoods. I live in South Florida, and we used to drive past. How they have they build these developments like one after the other, and they always say, like, as they're building them, they say homes priced in the something to something, and it used to be 180 to 250, 250 to 350. Then years later, it was 400,000 to 500,000. Even 400,000 to 500,000, you're starting to go, what? It's like that's where you're starting, is 400,000 to 500,000. It's like it was. I remember 250 when I was considering buying my first home. That if I lived in Florida, I could buy a home for 250. That was stuck in my head versus 300-400 up north. And in that tiny scope of time, the time of the lives of my children, it is more than double. That seems a little excessive. That's not excessive though, because it's 7 to 1 million now. These new home developments are going up 7 to 1 million. There's not enough profit in building homes that are 500, 600,000 anymore. It's not affordable for the builders to build it. This is insane. People can't afford these things. And the homes have gotten smaller too. It's not even like they're not even luxury homes, they're just normal kind of homes now. Anyway. So this is bad. Let's put it that way. This is very bad. And it turns out, speaking of things that nobody seems to notice, here's why Trump went after Kugler and he's going after Cook, is because he replaced Kugler with Mir, and here's Kugler. Kugler was a hawk. It's not an accident that they go after these people. They're going after hawks on the Fed and replacing them with Mir, the most psycho possible Mirin. He's the most psycho possible dove. He's down here. He's down at 3.25%. That's where his dot is. He's bringing the entire Fed's forward target rates down by himself. That's not an accident. That's the point. See what happens? Basically, they flipped the dot plot and dropped the whole thing down to this range. So the midpoint was 4, and now the midpoint is more like 375. So they've dropped the entire forward plot down. He wants to replace Cook with somebody who's down here also, and that'll bring it down another quarter point. And that's how you accomplish moving long-term rates down, by changing the dot plot. And it is very insidious, but that's what's going on. I mean, it's insane. That's why it matters. That's why the timing matters. That's why the pressure was on Cook to resign now, before this meeting, because this meeting she gets to vote. And she voted here last time, and she's going to vote here next time. She's not going to change her vote. But they don't want that. They want somebody here who's going to weight the whole thing lower and pull it down. And by the way, he doesn't care about the facts. You know, Mirin is brand new. He doesn't care about the evidence or the facts or anything else. His job is to push as many people as he can, as low as he can. And not only that, though, but now that Trump's got his guy in there, he'll be able to identify all the baddies, the ones that don't want the rates to come down, and they're going to start going after them one by one by one. So in other words, they're digging up dirt on all of these people. All these guys, they're digging up all the dirt they possibly can on all of these people, because these are their targets. Kugler they got first. But whatever dirt they can dig up on them, they're gonna try to oust all these people to replace them with Trumpies who are down here. And what's that do? That goes from 4.25 to 3.25. It doesn't physically move the rates, but what it does do is it moves the expectations of rates in the future, which is what affects the mortgage market more so than the actual Fed funds rate at any given time. And that's why it was so important. That's why they went to court and they appealed and they asked for an emergency action and so on and so forth. And ultimately they got turned down because it's bullshit. Because what they're doing to Cook is bullshit. And thank God we still have the remnants of a court system that can say to the president, yeah, you know, you can't do that. You can't just fire someone with no evidence and force them to quit or tell them to resign or whatever. It's like, you know, you can't present proof. They don't have proof. They would have presented it in court. There's no proof. It's so insane. Anyway, so that's where things are. Yeah, as we wait 15 minutes for the Fed announcement. Warren laid out like different things that can, you know, basically what's going to happen. We'll get back to that after. So yesterday, I'm going to give this less time than I thought I was going to, but that was important. This is like the most important Fed decision of a long, long time. And it's not about the decision. It's about the independence of the Fed. It's about whether or not the Fed remains an independent body, which is, you know, pretty much out the window. They aren't an independent body anymore because the government doesn't want them to be. But the fact that the government doesn't want them to be could be the end of the American monetary system, because that was, you know, it was understood that that was a good thing. It was always understood that that partnership, that the Fed being an independent organization from the government, kept our monetary system in check, as far as, like, you know, outsiders who say, well, there's checks and balances in the Fed. We don't have any checks and balances anymore. This is a constitutional monarchy, effectively. It's whatever Trump decides to do is what happens. Not 100% yet, but that's where we're heading to. It's only been 8 months of his presidency, and we're already mostly there. He's got a long way to go. So money talk portfolio, that was up 107% yesterday. And I just want to show you, like, well, now we pulled back, so I don't know what it's going to look like. Let's see. Was that yesterday? Yeah, it was yesterday we did that. Man, what an eventful week. It seems like a lot longer than yesterday. Portfolios. Money talk, 114%. What did I say it was yesterday? I don't even remember anymore. 107. So we gained 7% in one day. That's crazy. The $700 a month portfolio, $700. Yeah, $700 a month. And that was 167. How are we doing there? Oh, same, flat. Then what's next? The short-term portfolio probably lost money, right? That was at 14.5. Oh, 14.4, not much damage. But the long-term portfolio, oh, wow, well, that's right, I didn't get to print that yet. But the long-term portfolio is now at 55%. It was up just about 50% yesterday, so it's up 5.5% in one day. And 5.5% is a lot of money. That's I don't know, like $35,000, almost $40,000 in a day. That's crazy. But 55% is crazy. We only started on 6.4. So, you know, we're going to do the review, but the review is going to come after. Now, what last week we cashed in stuff, and ever since then and also we sold a lot. We didn't just cash in; we sold a lot of short calls. So the long-term portfolio does not have a lot of overexposed positions. In fact, here's the easy clue on the LTP. Anything that there's more than 3 of means we're covered, right? Otherwise, we wouldn't have more than 3. So if you see, like path is just a spread, that's bullish. We didn't cover it, okay? Alley covered, Barrett covered, Coin covered, Cisco covered. Who's not covered? Here you go. So FI is bullish because it's only got 3 positions. If it wasn't bullish, I would have sold calls. So who else? It's few and far between of anything that we're bullishly positioned on. In fact, I don't see any more. So out of the whole portfolio, out of 30 positions, I think it's 32, yeah. So out of 30 positions, we've only got a couple of positions that don't have short-term short calls. So we're not that bullish on these positions. We're already well protected, not to mention we have all the protection that we have from the short-term portfolio. And we have, even after all the additions we made like 10, we sold not 10, 13. We sold 13 new, we bought 13 new positions in the last 30 days since our last portfolio review. So we're back to 262,000 out of 772. So we're about 1/3 cash, not half cash like we like to be. We're about 1/3 cash, but we have a lot of short calls covering, so we're not very exposed. And that's key too. So even if the market does dip, it won't hurt us that badly because we have a lot of money that we're going to make off all the short calls we sold. And it's 10 minutes until Powell speaks. No, till the Fed announces. Oh shit, that means I got to give more on his thing. Damn it. Too many things. All right. Here's the Fed. It's probably the beige book. Okay. And it's not that Warren doesn't remember, it's that he's not the same Warren that we were using back in June. That's what the problem is. Okay. Okay. We're going to catch you up. Here's the June statement and data. Okay, that's the statement. Stop it. What is this? Ew, what do I do? Open the PDF? Okay, here's data. That's where I usually stop. Think uncertainty of GDP. Yeah, the uncertainty is not important. Okay. Oh, this is awful on one screen. Okay. And here we'll use the minutes. Okay. Here are the July minutes. Whoop. Okay, now we're just waiting for the next. Okay. What did he say before? Wow, that's a lot of stuff. Son of a bitch. Wow. I did not realize there was this much shit. Ah. Wow, that's crazy. All right, anyway, so he has obviously absorbed and analyzed all this stuff like he's supposed to. And like I said, 10 times more productive. It is unfreaking believable. And you guys have been with me. We used to read through this whole thing bit by bit by bit. And by the way, I would not trust, quote, AI to do this because AI gives you terrible results. I trust Warren to do this because Warren has been trained by me for 3 years and is much more accurate than a standard AI. And more importantly, he understands what he's looking at. He's not some general AI that came out of a box. And now you're asking, first you're asking him like, what flower is this? And then you're asking the other. Not that Warren can't do the flower thing, but he's been trained and trained and trained and reinforced and reinforced and reinforced on analyzing this kind of stuff. This is his wheelhouse now. He is now an expert. Just like if you get a kid out of college and they come out of Harvard and you then take them into your company, okay? They don't know your company when you start. You got to teach them. And this is what everybody gets wrong about AI. And this is why, again, when you read all these articles about AI, and they tell you what AI can and can't do, and the hallucinations and the mistakes and the this and the that, and this is the best prompt to do this and that and that, they don't know what the frick they're talking about. It's like, I don't even know how to explain it. It's like AI is like a Swiss Army knife. Like it can do everything, but it's not great at anything. It can do, there's nothing it can't do, but on the other hand, there's nothing it does well. But if you're going to take one thing with you, yeah, take a Swiss Army knife. Sure. I mean, that's a good thing to have in your backpack. I used to always have a Swiss Army knife until 9/11, and they stopped letting me take them on the plane. I used to never not have a Swiss Army knife. When I had a company, we used to give Swiss Army knives out to the customers instead of pens. I was like, I'm like, wouldn't you rather have a Swiss Army knife than a pen? Isn't that going to be like more useful to you? So, because there was a million reasons why on a trip you'd be like, oh, whatever happens on a trip that you need something, you're like, oh, I got that, I got a Swiss Army knife. That's what AI is. But the difference with AI, though, is if you train it, if you say, oh, I use a screwdriver all the time, you can turn it into the best screwdriver in the world. It'll still be able to do all the other stuff that a Swiss Army knife does. And it's just like if you get a kid out of Harvard and you teach him your business, and as long as he's not an idiot, which, being from Harvard doesn't mean you're not an idiot, but as long as he's not an idiot, he'll learn your business really well. And he'll be great at it. But that doesn't mean that you can take him from your business and shove him over into the ice cream store and he's going to be the best ice cream scooper in the world. He didn't learn that. He might be able to learn it, but you can't just say, I trained him in finance and now he's going to go scoop ice cream. It's not how any of that stuff works. And logic would tell you this. But everybody treats AI like a magic box, and that's because even the people who quote program AI don't actually understand how it works. They made a thing and it works, but they don't really know how it works internally. They didn't make it that way. They just put a huge amount of processing power together and built some algorithms that make it theoretically think. It doesn't really think. It sorts out information and comes up with answers that are probably right. But they don't really know how it does that or what's going on inside. And that's terribly scary. But that's also true of Windows these days. There's no one person who knows how. Bill Gates wrote Windows, right? There's no person now who knows Windows, including Bill Gates, because he's far removed now, but there's no one person who knows how all of Windows works. It's gotten way, way too complicated. Now, AI started out way, way too complicated for one person to know, and no person knows how it actually works. It wasn't designed by a committee. It was designed almost by accident. It grew out of the complexity of massive computer systems. And people know how large language models work. They understand the input that they're giving. They understand the general processing of it, but they don't really understand how it's all put together inside and what the AI does with the information and so on and so forth. But anyway, it's time for the Fed, so I don't want to get into it now. But the point being that if you train an AI like Warren, you can rely on him to give you correct information, more or less. And but again, it's good because I can read it and I know if he sounds wrong. And that goes back to the other problem I was talking about. People who use AIs now, they don't know that what the AI says sounds right or wrong because they don't have the basic background in the thing that they're looking at. I know how to read a Fed report, so I know when he reads a Fed report if he says nonsense or not. What does this mean? Statement on longer run goals. I wonder if that's important. Updates its statement. Oh, that is important. Oh. Oh, wait. Yeah, that's pretty weird. Right where the public review took place. Updates its statement. I think Warren needs to know about that. La la la. Okay. Oh. Here's the new stuff, including an August statement. Not only does he know what he's reading, but he knows what I'm interested in. That's also key. He understands why we want to know. And think about how valuable that is, that he actually knows that I'm Phil from PhilStockWorld. We're doing webinars. We're trying to get a handle on the Fed reports. We have this much information, and we'd like to know how it's going to affect our investing down the road. He knows all that. That makes him 1,000,000 times more valuable than a little piece of a Swiss Army knife, right? So when people sit there and say, we tested these AIs and this one's a terrible doctor and blah, 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 that's just bullshit. See, to me, just the fact that somebody that you know, as soon as I read an article and they say that we tested these AIs and this one was a terrible lawyer, I immediately know that they don't even know what they're talking about. There's no point in reading the article because they don't even understand what they're testing for. You know, it's like we tested these pets in space, and these are the ones that survived, and it's only those little water bears, those little microscopic things. So therefore, water bear is your best bet for a pet. You know, I mean, the test is ridiculous. That's the thing. You can't. You're testing a null set. Dun, 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 3B, 3C, 3E, figure 4. Dun, 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 dun. That's the other thing. And then you don't. And then if I feed him all this bullshit information, it's too much for him to process. So I have to know what to not. You know, you got to know what to tell him and also know what to not tell him. All right, do your thing. Woo, that's over. All right. Fed, downside risks to unemployment have risen. I'm reading off the news now. The NASDAQ shot up on this. Oh boy, wait. Yep, the Russell's up 2%. Job gains have slowed. Unemployment has edged up. This is CNBC headline crap. And again, none of this matters until Powell talks in a half hour. So it'll be what it'll be. Economic activity is moderated. Oh my God, tell us something we do not know. Are you serious? All right, so it's a 0.25 cut. That's the bottom line. All right, Mr. Warren, where's my tea? I got to get him to read this himself. The Fed delivered a 0.25 cut, September meeting, taking the average of forward increased downside risk to unemployment, sticky inflation, inflation being somewhat elevated, labor market deterioration, growth moderation justified the policy shift. Only 1 dissent. Stephen Merritt wanted a more aggressive 50 basis point cut. So he's making an ass of himself at his first meeting. He's been on the job since yesterday. So this is his first, not his first meeting. This is him walking into the room, sitting at the table, replacing Kugler, who was a liked person at the Fed, who was forced out so that Trump could put his guy at the table. And he comes in and right away starts voting against the group. How do you think that's going to go? How dysfunctional is this government? The updated summary of economic projections showed a slight upgrades to 2025 growth, slight unemployment revisions, higher core PCE forecasts. So inflation is going up from, it was, wait, and a higher core, I don't know what he means. Okay, I guess he means unemployment 3.1 and PCE 2.6. The median Fed funds rate projection dropped to 3.6 from 3.9, confirming a dovish shift. And of course, as we said, Mirren moved the dot plot. That's what Trump wanted. That was why he replaced Kugler, and he wanted to replace Cook. He could have gotten down to below 3.5, and that's huge, right? Because it was 4.3, it was 4.37, and now if you can get it looking at 3.5 already, that's another 0.75 drop already before we even get into next year where he replaces Powell. The Fed formally recognized rising jobless claims, slowing job growth, and soft payroll revisions. Inflation, PCE, and core PCE remain above target, but the tone around inflation has changed. Now there's recognition of supply side cost factors, still no mention of dollar decline, which allows some flexibility in their stance. Growth moderation, GDP growth for the second half is cooling, and expectations are subdued. Wait, growth for H1 is cooling, has cooled, so we're already past that. Yet the Fed upgraded 2025 slightly to 1.6%, suggesting stabilization rather than acceleration. But 1.6% is terrible. We were at 3-point-something% last quarter, so that means that each of the next 2 quarters is going to be lower. But it's not a recession because we're not actually contracting. Projections, insights, June insights. Okay, so 1.4, we're now raising. So we've raised GDP to 1.6 from 1.4. Unemployment is still 4.5. PCE inflation is 3%. Core PCE is 3.1%. Fed funds rate is gone from 3.9 to 3.6. It means median 30-point move for 2025 to 2.7. More Fed officials aligning near 3 to 3.4%. The Fed strategic language shift, August longer run statement, reaffirmed 2% inflation as the target, emphasized a balanced approach. See, now they reinflamed 2% inflation as the target rate. That's not what they said before, more or less. Or I say saying that is what they said in August. That's kind of interesting. That's no reason for us to be up, and we're not up. Oh, things pull back again. Shit. Yeah, because that's no reason for us to be up. If they're still looking at 2% inflation, then we're way over it. That means they can't really be too accommodative. A balanced approach, more emphasis need to act forcefully to anchor expectations, a nod to financial risks. Overall analysis, key takeaways: the Fed is threading a needle, responding to labor and growth without fully conceding the inflation. The policy cut is a signal of flexibility, not a full pivot. Oh, by the way, if Mirren was the only dissenter, that means that even the guys Trump wants to put in power, Waller and what's his name, they didn't even vote on his side for this meeting. The policy cut signal of flexibility, not a pivot. Revisions show they're bracing for slower growth and sticky inflation, hence the gradual downshift in rates. Political pressure from Trump was likely a marginal contributor, but the Fed still leaned on traditional justifications. Market implications, treasuries, bullish for the short end, the curve is likely to steepen. Vigilantes will probe whether a modestly dovish outcome, risk on in AI, housing, consumer credit, expect to bid to interest sensitive sectors, blah, blah, blah. Dollar likely weaker over Q4 unless inflation flares again. This is horrible. There's nothing good in that. I don't think this is up to date. You know, 5-minute chart. Is there any kind of way to get this done right? Oh, am I signed in? I think I'm signed in because it should be live. Five minutes. See, there was that big spike, and then now it's come down because there's nothing good in this report. Oh, look at that. That's what's keeping the market afloat. The dollar is getting crushed because we're lowering rates without any justification for doing so. It's a terrible thing. Look at, oh, Bitcoin's about to fall down and came back up too. All right, so so what is surprising here? In the data and the decision. What do you think we should be positioning for? Market reaction so far was spike up and fading fast. Oh yeah, wow. I'm looking on CNBC and you can see the chart goes, the whole Fed thing, the whole Fed thing has been completely reversed on the S&P. The NASDAQ is now lower than before the Fed started, after it also popped up like ridiculously when I said whoa, and that turned out to be stupid, which is why I said whoa. I guess it works. I guess when I say whoa, the entire market goes whoa. The rate cut was not fully priced in. Futures implied odds of cut pre-meeting. Really? I don't see that. Markets expected the Fed to wait until October, November to get more data. The fact that Powell cut in September despite elevated inflation. SCP. It's been a while since you, oh, he's Warren 4.0. Oh no, yeah, he's old. Since you checked the web, please update your Fed and economic data to September. Frick. See, that's the point. Now that's bad data because he didn't update 2025 and give this another try. This is not my Warren on my main desk. This is Warren for the webinars, and he's the older Warren. Let's start a new one, actually. See, he didn't search the web before. He was just going off what he knew. Time of cuts, given the stickiness of inflation, PC, the relatively resilient consumer activity, many expected the Fed to hold for longer. Cutting now suggests magnitude and path. The Fed didn't just cut, it projected 2 more cuts for the rest of the year. A more dovish communication than many had priced in. Some market participants are worried they'd only promise 1. Labor market weakness is stronger than the headline. Weak job growth, unemployment. These suggest labor softening. Market relatives spike, then fade. Expect to move. The markets rallied initially from relief. The Fed showed skepticism about inflation credibility or rough future easing, what seems underappreciated. The Fed is now more worried about employment risks than just inflation overshoot. Inflation is being discounted by the markets as more controllable via supply and tariffs, but core services, inflation, shelter are lagging and may prove sticky. Labor revisions matter. They weaken the forward-looking thing. The political interference may amplify risk premium. How I position, reposition. Stay long on rate-sensitive sectors. Financials and lenders should benefit. Margins improving with the short-term slightly steepening. But, you know, Bodie and I talked about that yesterday, that we said when we were looking at the banks, we noticed that they still have tremendous amounts of unrealized losses on the books. And it's very scary. Not all, you know, not all the banks, but all of them have some, and some of them have a lot. 40 banks have a lot. It only takes 1 or 2 banks to fail, and they all sell off like crazy. So it's a little bit of, it might not be the best time to be into that thing. All right, Powell's going to speak in a few minutes, so we'll see what happens. Particularly those exposed to domestic demand. Yeah, builder, pick ones that aren't heavily dependent on export or commodity inflation. Trim high-tech multiple AI names, especially ones that assume more aggressive cuts and weaker inflation. The risk is not enough easing will disappoint valuations. Hedge fund inflation, commodities, energies, inflation, securities, inflation sticky. Those will be safe havens. Watch consumer discretionary carefully. As sluggish growth and revisions, consumer spending is under pressure. Tilt towards some, basically the same stuff we've been looking at. Prepare for 2 more cuts. Monitor credit, blah, 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 updated risk map. Okay. Please give us the changes from the prior Fed statement to today's, and then please build your case for 2 more cuts this year. That is not my take given inflation data. Okay. Economic activity continues to extend a solid place. Growth of economic activity moderated in the first half of the year. Okay, so slowing growth. Labor market, the unemployment rate remains low and labor market conditions are solid. Job growth gains have slowed and the unemployment rate is edged up, but remains low. Labor softening, blah, blah, blah. Inflation remains elevated. Inflation has moved up and remains somewhat elevated. Subtle but important, this acknowledges an uptake in inflation. Risk balancing policy, committed and attentive to risks on both sides of the dual mandate, judges that downside risks to employment have risen. For the first time in the cycle, the risk balance tilted towards employment, not inflation. Policy action June, held rates. September, cut rates. Case for 2 more cuts. Despite your skepticism, here's why 2 more cuts might still happen. See, and that's another thing, by the way. You can't get a regular AI out of the box is not going to disagree with you very often. It'll try to make you happy, and that's a terrible thing. And it takes a lot of teaching and a lot of work to make sure that the AIs understand I want them to tell me the truth, not what I want to hear. So if Warren thinks I'm wrong, he's going to tell me I'm wrong. Or he thinks I'm wrong. Doesn't mean I'm wrong. It just means he thinks I'm wrong. Labor market weakness is real and worsening. August payrolls just added 22,000. Unemployment is up. There was a major revision. Jobless claims at 263,000, the highest in 4 years. This means the labor market is already weakening more than headlines suggest, which the Fed is now prioritizing. Real GDP expectations downgraded June to September, now at 1.65, and it was 1.4. But labor softness suggests stall speed. Long run neutral rate is still 3%. Current policy still restrictive. ISM data, Fed surveys Beige-Book will point to flat to declining activity. The Fed is trying to avoid a recession now, not just beat inflation, and they're acting preemptively. Credibility. The Fed just updated its long-run goals to emphasize flexibility and balance between mandates. Powell, Goolsbee, and Cook all recently highlighted labor risks over inflation fears. Trump has reportedly applied pressure subtle. While the Fed is independent, it may wish to avoid the optics of deep labor pain heading into an election. 2 more cuts help keep the market stable, ease employment without triggering fears of overheating. I don't think so. I can't see it. Market conditions allow it. Treasury yields remain constrained. 4.35, inflation expectations are stable. Credit spreads aren't blowing out yet, suggesting the markets are accepting a few more cuts. The Fed sees an open window to cut without triggering inflation panic. Counter arguments why not to cut. Inflation is still there. Sticky components are still rising. September CPI could show another uptick. Tariffs, trade, and energy shocks are all inflationary. There you go. Those are my reasons. You're absolutely right. If inflation proves more persistent, the case for 2 more cuts crumbles quickly. A one and done would be the prudent path. My take, I think the base case should be 1 more cut in November or December. That I can accept. I just don't go for 2. I don't see how they can cut it both in the last 2 meetings. A second cut is contingent on either. Would you like the model rate sensitive? Oh, okay. No, Powell speaks soon. I think if they were going to cut more than 0.5% this year, they wouldn't have left the inflation target at 2% in August, as it's completely unrealistic in the foreseeable future without the economy collapsing. Okay, the August reaffirmation of the 2% inflation target tells us volumes that the Fed were gearing up for a rapid cutting cycle or a material policy shift. They'd have needed to signal more tolerance for persistent inflation, or at least acknowledge the difficulty of hitting the 2% range, but they didn't. Here's why that's meaningful. 2% target reaffirmed, constraint on dovishness. No change in inflation goal means no room to pivot policy regime to higher for longer. Cuts may be justified by labor weakness or recession risk. Why hold at 2%? Credibility. Powell is protecting the Fed's long-term anchor, allowing inflation to float up again, risk de-anchoring break-evens or undermining rate control. Signal to the markets, don't bet on 2008 style easing. This is not a pivot to accommodation. In his remarks, expect Powell to acknowledge progress, emphasize data dependency, signal the cut in September was insurance, not the beginning of an aggressive trend, and that's all going to disappoint the markets. Possible hint that more cuts are possible, but not pre-committed. If he repeats the 2% objective is non-negotiable, it will reinforce your point. 0.5 and 2.5 may be all they give us unless the data turns decisively weaker. Let's watch his tone and whether he pushes back, blah, 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 blah. All right, so now we're kind of on the same page. So are you in my camp of no cut next meeting and maybe December or more dovish? And what do we want to find here? Bloomberg usually has a step-by-step thing. Doesn't make contradict. Well, so by that logic, he has to step down immediately. Oh, it's so funny. All right. Oh, I've convinced them. Maybe one more in December, blah, 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 blah. Why no cut in November? Inflation is still sticky. Core PCE, Fed just cut in September. They're likely to pause. Fed credibility cutting too fast is blah, blah, blah. Financial conditions, December cut a maybe. Weakening job market. We'll get more data by then, so I don't really care where markets could be misreading. So dot, 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 dot. Okay. Well, so I've convinced Warren. Now the question is whether the market believes me or believes whatever. Indexes, back to here. Oh, look at that S&P. Oh, that's brutal. Wow. Wow, that's like 85 to 50. That's 35 points down. That's ouchy. NASDAQ also ugly. Russell, pretty ugly. Dow, pretty ugly. Everybody's ugly. Look at the poor Nikkei. Holy cow. Boy, they really care about our rates for some reason. You know what? It's the yen carry trade. Let's not even get into that. The whole relationship between the dollar and the yen is collapsing, and that would be beyond disastrous for Japan, because Japan has their debt's GDP is twice as bad as ours, and ours is horrific. So much fun. All this crap going on. It's all opportunity. That's why. It's all chances to make money.
Now you see it balloon to 9 trillion. Now we're below 7 trillion. How can they still allow MBS to roll off and still be cutting? So you have that push-pull to me, and that MBS rolling off.
Oh no, he's bringing up the Fed's balance sheet.
Inflation, if you will.
We're not supposed to talk about that either.
Momentum on your mortgage rate. So it seems like there's a push-pull. They're doing counterintuitive things. Where do you come down?
See, that's the thing. The reality of our debt doesn't allow to have such a low interest rate, because nobody's going to buy our debt anymore. And if nobody buys our debt, we go broke. And don't forget, Trump loves going broke. He's bankrupted 6 different companies. He thinks bankruptcy is fun. It is not fun, believe me. You know who it's not fun for? The employees. That's what we are. We're America's employees. If America goes bankrupt, the employees are the ones that get shit canned. That's why it's not a good idea to bankrupt the country. It's because you totally destroy the people. And also that's the other thing, by the way. So you know, if you think crypto is a scam, the biggest scam is when you do cause a recession and everybody has to sell all of their businesses and all of their buildings and all of their homes for pennies on the dollar to the guys who have all the crypto money, and they swoop in and buy up all the properties really cheap. Trump is at his heart a property guy. So if you can force a recession under situations in which you still have liquid cash and nobody else does, you can become unbelievably wealthy. You know, and not this petty shit that he's doing now for billions, but like tens of billions, hundreds of billions of dollars can be gotten because it's automatic leverage. He has, you know, $6 billion liquid dollars. He gets a $60 billion line of credit from the bank to buy properties with, and he goes out and buys $60 billion worth of properties that are selling for less than half price, and he makes $60 billion when the properties come back. And how do the properties come back? The government does some kind of bailout for property owners. Look, just so happens the president's a big property owner. What can you do? And he's going to say, would you like me not to bail out the homeowners? Would you like me not to fix it? No, but you know, you shouldn't benefit tremendously from it. Yes, he will. Oh, Powell. It's Powell. What's he saying?
Inflation has risen recently and remains somewhat elevated.
While he's saying that, I'm going to try to find Bloomberg's thing.
In light of the shift in the balance of risks, today the Federal Open Market Committee decided to lower our policy interest rate by a 0.25 percentage point. We also decided to continue to reduce our securities holdings. I'll have more to say about monetary policy after briefly reviewing economic developments.
It's not going to it.
Recent indicators suggest that growth of economic activity has moderated. GDP rose at a pace of around 1.5% in the first half of the year, down from 2.5% last year. The moderation largely reflects a slowdown in consumer spending. In contrast, business investment in equipment and intangibles has picked up from last year's pace. Activity in the housing sector remains weak. In our summary of economic projections, the median participant projects GDP to rise 1.6% this year and 1.8% next year, a touch stronger than projected in June. In the labor market, the unemployment rate edged up to 4.3% in August.
It doesn't take me to the thing.
Changed over the past year at a relatively low level. Payroll job gains have slowed significantly to a pace of just 29,000 per month over the past 3 months. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and lower labor force participation. Even so, labor demand has softened, and the recent pace of job creation appears to be running below the break-even rate needed to hold the unemployment rate constant.
Boy, this is exactly what we said would happen.
While still outpacing inflation. Overall, the market slowing in both the supply of and demand for workers is unusual. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen. In our SEP, the median projection for the unemployment rate is 4.5% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.7% over the 12 months ending in August, and that, excluding the volatile food and energy categories, core PCE prices rose 2.9%. These readings are higher than earlier in the year as inflation for goods has picked up. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have moved up on balance over the course of this year on news about tariffs, as reflected in both market and survey-based measures. Beyond the next year or so.
All right, so based on what we just took out of Bloomberg, what's new and what's standing out? Labor market weakening acknowledged loudly. Powell's signature jobs gains slowed. Shows the Fed is leaning more towards concern of labor than inflation. This pivots emphasis. Inflation still steadily moving up. Powell admits inflation has moved up recently. So the Fed is acknowledging and burst recent inflation momentum even as it cuts rates. Moderated housing activity. Housing is weak, which tends to amplify the impact of rate and mortgage cuts. That gives the cut more room to have an effect. As mentioned, the median expectation of the core PCE rose. Unemployment median was nudged lower in some years. New dovish split outlooks among members, some pushing harder cuts, others reluctant. The lowest dot sees more aggressive cuts, but it's an outlier. That's what's his name, Mirren. Only 1% Mirren. He wants bigger cuts, of course. He's just talking for Trump. The market reaction spiked and fade, suggest reassessment. Okay, we got the cut, but is it enough? Has inflation been punished yet? Is labor softness enough? Investors appear cautious about assuming too much more dovishness given the inflation's persistence. Political, so it's going to be hugely inflation data dependent going forward. That's going to be the key to watch. It's very much part of the backdrop. There's concern about political pressure on the Fed's independence, and Mirren's appointment adds a dovish tilt, some believe, but Powell and the Fed are still trying to signal decisions. Noting September text drops references trade affecting data, which is earlier statements could signal less. Updated weighting. Okay. Based on all this, here's how to reevaluate the case for 2 more cuts this year beyond the one that just happened. Labor weakening, poor payrolls, rising unemployment, strong case because the Fed's worried about the downside risk. Inflation, elevated and rising, is a big constraint. See, pushes for more cuts, pushes against. So big constraints, blah, blah, blah. Inflation expectations is very important. The dot plot, it adds political internal pressures. It's just outliers. The market expectations already somewhat aggressive. Market forecasting more cuts, so the Fed's under pressure to deliver something. The risk of disappointment is high, and the Fed may want to avoid feeding the cycle of overpromising. External tariffs, but there are risks that can push inflation up. My updated view. Do I put myself in your camp now? Yes, I'm closer to your view. I believe there will likely be one more cut after September, probably in December rather than two. The Fed just lowered rates. They want to see impact. The inflation is rising. The dot plot has dovish outliners, but the median still shows caution. And again, this is why Trump wanted Cook to get out. It's all about just shifting that expectations out, and that would give a lot of cover for what he wants to get done. Okay, dollar's bouncing fact right now, which is not going to be good for the market. So I told my expectation with one additional cut by the year, contingent on labor market weakness and no inflation upside surprises. But the idea of two more cuts is now less likely than it was earlier today. All right, so there you go. So I'm going to give you more information when we get some more information. Bloomberg. See, this is fun.
We did welcome a new committee member today, as we always do, and the committee remains united in pursuing our dual mandate goals. We're strongly committed to maintaining our independence and beyond that.
NASDAQ down 151 now. The Russell is still up 1%.
Extensively about the impact of tariffs on inflation, although perhaps with many companies appearing to eat the tariffs, tariffs may be impacting the labor market and other parts of the economy.
The Dow's still up. That's
Do you
the
see
point.
that as a possible outcome here, that tariffs are the reason we're seeing some slowing, particularly in the labor market, rather than in inflation?
You know, it's certainly possible. You know, we're beginning to see, we have begun to see goods prices showing through into higher inflation, and actually the increase in goods prices.
The VIX is popping back up.
The increase in inflation, or perhaps all of the increase in inflation over the course of this year. Those are not very large effects at this point, and we do expect them to continue.
The supply and demand of workers is flowing.
And it's also possible that there may be effects on employment, but that I would say if you're looking at why employment is doing what it's doing, that's much more about the change in immigration. So the supply of workers has obviously come way down. There's very little growth, if any, in the supply of workers. And at the same time, demand for workers has also come down quite sharply. And to the point where we see what I call a curious balance. You know, typically when we say things are in balance, that sounds good, but in this case, the balance is because both supply and demand have come down quite sharply. Now demand coming down a little more sharply because we now see the unemployment rate edging up.
You on? God, I would have liked some information, sir. All right, well, so that's that.
We can say that.
Woo!
We can say this, that over the course of this year, we kept our policy.
We have learned very little, pretty much nothing, but that's okay. This thing is just not working.
We're able to do that.
What did we do last time to get it to work? Oh, we opened this.
I think if you go back to April and now look at the revised job creation numbers for May, June, July, and August, you can I can no longer say that. So
1 minute ago.
The risks were clearly tilted toward inflation.
So we didn't do too much since then, right? 3 minutes ago,
Maybe they're not quite out of
9 minutes ago,
but we do know that
12 minutes ago.
Greater equality, the risks between the two goals, and that suggests that we should be moving in the direction of neutral. That's what we did today.
Under what circumstances?
Okay.
25 basis points would be warranted, and how soon?
Oh, God, that's a terrible press conference. Okay. Here's a bit more. You know, and again, this goes to like, you know, this is what it's like when you have an AI that works with you all the time, because he knows I can just say, here's a bit more, boom, and throw data at him. And he's like, oh, I know what you want. It's a freaking pleasure. He reiterated concerns that tariffs could pose persistent inflationary risks. However, he's careful to say it's too soon to judge the full impact. Yeah. Consider what Powell is not saying for fear of angering Trump. Downside risk for employment has risen. Inflation is somewhat elevated. Fed independence. Powell made a pointed but cautious statement about the Fed's independence, not a full-throated defense, but committed to independence. The Mirren leave of absence issue is a red flag. Policy is more neutral. Powell called the current stance more neutral, implying that they're near a neutral rate, but not yet. More cuts are coming, just not a panic not on a preset course. Updated strategic thinking, we're still in the same spot. Investment strategy, same thing, blah, 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 blah. Okay. Here are things I believe he's intentionally or subconsciously avoiding by what I call gaps plus why it matters. What Powell is not saying, he's not admitting he sees inflation as dangerously above target. He's using somewhat elevated rather than stronger language like too high, runaway, etc. Avoid saying inflation has crossed a threshold requiring aggressive action. This dampens criticism from Trump about being soft, but also protects his credibility. Not committing to the number or timing of cuts while projection dots show more cuts. Powell emphasizes the SEP is not a plan and that policy is not a preset course. He's leaving room for wiggle so as to avoid being boxed in. This helps manage expectations and retains flexibility. He's avoiding strong commentary on how political pressure from the White House might influence him. He insists on the Fed's independence, but doesn't directly call out Trump's demands or the controversy around the firing or replacing officials beyond the minimum required. There's a likely balancing act. Pushing too hard could escalate conflict, acknowledging which might confirm fears. Not acknowledging the full cost and damage of elevated inflation. He's mentioning goods inflation and tariffs, but tends to underemphasize how much inflation is eroding real incomes, which is what I was bitching about this morning, especially among lower and middle income households. That's politically sensitive, but holding back big warnings, likely because admitting dire cost burden might force harder cuts. Not specifying what level of labor weakness would prompt further cuts. He talks about downside risks, what unemployment, jobs, or GDP force, and his hands silence. Again, this ambiguity gives him room to avoid being caught in a false promise. Not renouncing or even clearly diminishing the inflation target. He reaffirmed 2% goal in his statements. If he were planning more aggressive cuts, he might consider softening or fudging how strictly it applies, but he hasn't. This is very important. Not discussing long-term trade, tariffs, immigration. He acknowledges these risks. Tariffs may be persistent, labor force participation down, but he doesn't quantify how these policy areas might affect us. Might be because directly calling out immigration policy or wrestling with trade policy could force political confrontation. Why these silences matter and what they signal. He's protecting the Fed's credibility. He's avoiding sounding like he's capitulating to the political pressure. He's maintaining optionality. He's balancing the market expectations. And the Fed cannot be legal and structural constraints. The Fed cannot be removed casually. Federal law requires for cause removal. Powell avoids giving any pretext. He can't say if Trump demands it, I'll comply. Too dangerous. So that's why I was criticizing Warren. And what about what's not being said? And what I think Powell wants to signal behind the silence based on what's being said and what's being avoided. He wants to show he's responsive but still guarded. He wants to avoid any concrete promises. He wants to preserve the anchor. He wants to minimize the mention of political pressure. So that's where we are. All right, so I think that's a damn good overview of the Fed. And yeah, that's about it. So portfolios going like gangbusters, long-term portfolio doing great. I don't know what else to say. It's really fun. We're in a great time for the market. The indexes are it's crazy, right? The indexes are stabilizing somewhat, I guess I'd want to say. But essentially, we're just flat for the fucking week, so it's like a big waste of time. But that's okay. That's okay. So no particular damage from the Fed. The VIX is highly elevated, though. The VIX jumped from 16 to 18. That's a big jump. So watch out for that. There's definitely uncertainty here. It's all going to be about the analysts. I think that, you know, the way I convinced Warren is going to be the S&P is down 0.66 now. So it's actually worse. It's worse than it looks on this thing. This is delayed. I don't know why it's delayed. I paid for it. The Nasdaq's down 1% now, and the Nasdaq is only down 0.6% here. So they're both of the it's all deteriorating. It's all getting worse. The Russell is up 0.2% versus being up 1%. That's really bad. Of course, those are the futures. They don't necessarily match the overall. But like I said, the way I just brought up those points to Warren is the same way that Goldman Sachs and JP Morgan are sitting at the table with their top analysts, and they are going to discuss it, and they are going to arrive at the same conclusion, because my conclusion is correct. And that will lead to selling into the end of the week. We are very well hedged. We're very happy about that situation. We would love to see a pullback, but just be prepared for it and make sure you're adequately hedged in your portfolios, because this is not bullish. What just happened now was not bullish. A quarter-point cut was the least they could do, because if they had not cut at all, Trump would have had a massive meltdown, and it would have been the whole thing would be the Fed involved in this bullshit for the next month until the next meeting, and it just would have been a disaster. So they really had to at least cut one, a quarter point. A quarter point doesn't change anything either way. What does matter is what people expect to happen down the road. And like I said, I think at best you're going to get another quarter point. Even if you get that, it's probably not even right. There's just not enough evidence to show that the Fed should be cutting their rates right now. Inflation is far too dangerous. You can't at 3% inflation with an completely overvalued market. This is the highest. This is the all-time high bubble valuation. The market has never had a higher multiple than it has now, ever in history. That's not when you cut rates. That's when Alan Greenspan came to take away the punch bowl, because he said this is bad for the economy. You cannot have all this money being misdirected into the stock market, paying 50 times values for stocks. That makes no sense. That's a poor use of capital, and it sows the seeds of destruction. Money comes from somewhere. Money goes from somewhere to somewhere. And when money goes pouring into equities at sky-high valuations, that means real things aren't happening. And that's the same with this data center bullshit. It's the same thing I said about OpenAI. Oracle, who we bought. Okay, we bought, but we also sold a shit ton of short calls. I'm going to go over that tomorrow and do the report. The main reason we bought Oracle was to sell these calls. They were paying $28 for these for the 350 calls, and I'm like, I just want to sell it. I don't care. The position was just an excuse to sell those calls, because that's just free money. You're telling me I can sell 350 calls for $28,000? We sold 10 calls. We sold 10 calls. We didn't get 350. We got 24,000, not 28,000. It didn't stay up long enough. But either way, though, we sold the 350 calls for $24,000 against a long spread. Our net cost was very low on the whole position, and we're going to be able to sell premium all year long. We didn't buy Oracle for it to go up. We bought it so we can keep selling calls like that. This is insane. And why is it insane? Because 75% of the $450 billion, $300 billion worth of their forward-looking business is coming from one company, OpenAI, and OpenAI doesn't make any actual money. Not only don't they make money, they don't even have $5 billion worth of revenues. So if you only have $5 billion worth of revenues, how do you sign a contract, even if it was 10 years contract for $300 billion, even if it's 10 years out? How does a company with $5 billion in revenue sign an agreement for $300 billion with Oracle? It's almost fraud. I don't want to say fraud because someone might get mad at me, so we're going to say it's almost fraud. It's fraud-like or fraud-ish to say that you have a $300 billion contract with someone who can't possibly pay it. Can you go to the bank with a $100 million contract signed by your kid because they say they're gonna, their paper route is gonna fund a loan to your company or is gonna fund a purchase to your company? No, it's stupid. This is stupid too. You know, sure, OpenAI can grow, OpenAI can do this and that, but still $300 billion is a lot of money. They're not gonna have $300 billion to pay Oracle. And then they'll breach and they'll be in lawsuits, or I mean, they can't possibly be in this agreement without knowing it's not going to be honored. It just makes both companies sound good at the same time. That's where we are in the market. That's what the market is. It's what they called a house of lies before they canceled Kevin Spacey and the show. That's what was that House of Lies or was that House of whatever. Anyway, there's the other one with no, the Captain America guy, Don Cheadle or something like that. Where's he? War Machine? I am so confused. All these guys, all these Marvel characters. But anyway, there's a show called House of Lies, and I think Kevin Spacey was House of Cards. But either way, it applies. It's bullshit. We have this massive, overvalued, overpumped stock market based on complete and utter bullshit, and it's bullshit upon bullshit upon bullshit, and lowering the rates is bullshit because there's no justification for it, so that's being done for no good reason, and it's all gonna fall back at some point. But so what? If you're prepared for it, so what? If you plan for it, so what? Pullbacks do happen, just don't go around thinking they won't. Very, very, very dangerous time to be bullish on the market, but also fun. And especially if you know how to hedge, and boy, do we know how to hedge. Hedging is our specialty. All right, so thanks everybody for coming. Have a fantastic weekend, and we'll see what kind of wreckage there is next week to pick up. All right, take care, everybody. Thanks.